If you look at a chart of gold and take out the lockdown record highs, it's really done very little since 2019. Why? What's going on? And the big question is gold now in the shadow of the crypto market and as a big alternative to the mighty dollar? Welcome to this edition of IG Trading the Markets podcast. I'm Jeremy Naylor. We're now joined by Angelos Damaskos, fund manager of the Junior Gold Fund and a specialist in precious metals, and he's been personally investing in the gold market since 2003. Angelos, welcome. I guess because you've been in the market now for so long, 18 years or so, you remain a gold bug. So I guess you're going to be talking about gold on the upside. I want to take a look at the risks of investing in gold in just a few moments' time. But first of all, what's your comment on where we are now at the moment on the gold price?
Thank you, Jeremy, and it's a pleasure to be on the show again. As you pointed out, for those of us who have been investing in gold for a very long time and being fundamentally gold bulls, we have to look at the longer-term development of the cycle as opposed to the intra-cycle volatility, which has been happening over the last few years. So if you look at, for example, when we started investing in gold and gold miners in 2003, which was the then low price level for gold of about $250 to $300 an ounce, gold has massively outperformed the equities and almost every other commodity. It has risen by more than 6 times to the high point of last August, in fact, of 2075. Now, within that longer term cycle, which reflects what's been happening in the global economic environment and how governments have approached their budget deficits for such a long period of time and have reverted to the so-called monetary theory that believes that provision of liquidity to the markets is the answer to the deficits, and it doesn't matter how much the state debt rises. That's what the modern monetary theory suggests. But however, if you look at the various asset classes, they do point out that there is something much more important happening in terms of how investors perceive the preservation of their wealth and their asset quality. So gold has always been a safe haven asset. It has been a store of value in the eyes of some longer-term fundamental investors, not least the central banks of the world, who have been accumulating gold for a very long time. And in fact, the World Gold Council statistics show that global central banks have been, again, net buyers of gold for the last year or so, obviously in response to the monetary situation of the world. But looking at the nearer term development of the cycle, as you pointed out, since the mid-2019, when we saw the price of gold again break up and rise significantly, and I would point out that the previous near-term low was about $1,050 an ounce at the end of 2015. And since then, we have moved significantly above that, to about 1760 that we are today. You know, what happened really is after the COVID-induced crisis on the world and the massive liquidity injections by the central banks and the governments around the world to save the economy from collapse, people realized that the real money would be debased, because that's really the economic consequence of such a massive liquidity injection by central bankers and such massive money printing. So the real fiat currencies are being debased around the world, not specifically the US dollar, the euro, or the yen, but almost every currency around the world is being debased, is losing its value. So the response of people is to look for wealth preservation havens. And not only gold, but also investing in companies, real industrial companies, which explains why the stock market has done so well for the last year and a half.
Yes, I want to get into how you're investing in the market in just a few moments' time. What are central banks doing at the moment with their relationship with gold? I mean, in the past, central banks, they invested heavily in gold and it was used as a sort of a base anchor on the economies. But that's not such the case in the modern world. But what are central bankers doing at the moment? Are they buying or selling gold?
Well, as I said earlier, the World Gold Council statistics indicate that the central bankers have been buying for the last year or so and have been increasing their allocations to gold. Now, this varies between central bank to other central banks. For example, the Central Bank of Russia has been a very big buyer of gold bullion since the sanctions started being imposed on it after the invasion of Crimea, etc., because they wanted to insulate their reserves from the effects of the US dollar and the sanctions. The Central Bank of China has been investing heavily in gold in order to diversify its monetary reserves for a very long time, for over 10 years. But there are other central banks like the Indian Central Bank, the Polish Central Bank, etc., who have also been investing heavily in gold in the last year or so because they realize that they need to have an alternative safe haven for the reserve base to cushion against unexpected sort of volatility.
What about the outlook for the global economy? How do you see that working with the price of gold? You talk about the debasement of currencies, and of course this is brought about in part by inflation. But as you say, the massive amount of liquidity that's being pumped into economies it has to be said, for the last 7 or 8 years, expected to have driven really high inflation. Now that hasn't come about. So one has to ask whether or not we're in a new sort of paradigm with regard the global economy. But do you see inflation picking up, and do you see this being a driving force behind the prospect of higher gold prices?
In terms of traditional economics, Jeremy, liquidity injection and the debasement of the monetary base should result in very high inflation rates. Now, the central bankers, particularly the Fed, do not believe this will be the case. They argue that the current high inflation rates we are seeing is because of the breakdown of the logistics networks in the world economy, because of the people remobilizing, coming back into work, companies restocking as they drew down on their inventories through the lockdowns, etc. So there is an element of that happening at the moment. That's why we see inflation rates hitting 4%, 4.5% in the UK, in fact, for the last few months. But I believe that inflation will remain well above the target of the central bankers for the foreseeable future, because this liquidity injection finds its way into all sorts of segments of the economy. And now we see it even in the labor market. Unions in many important industries find the opportunity of labor shortages to negotiate significant pay rises. So arguably, all of that cost, and even if you think about the cost of the lockdowns, the damage inflicted on industry, a lot of that, in order to recover that cost, some of it has to be passed down to the consumers. So inflation, I think, will be here to stay in the very high sort of target range for several years to come. And at the same time, because of the huge rise in indebtedness, both at the government as well as the private sector level, central bankers will not be willing to raise interest rates too quickly and too high for fear of destabilizing the economy. So I think, the economy has grown out of the pandemic-induced recession very quickly, but now with very high inflation rates, and particularly cost inflation of raw materials, I think the economic growth rates are going to decline significantly.
Mm. I want to talk about the crypto market, and as I said at the top, whether or not cryptos are now becoming a big and more serious alternative to the mighty dollar. I mean, I think if you look at this in context, my understanding is that the gold market is worth something like around about $2.4 trillion. The crypto market's worth something like $1.5 billion. That was readings from several months ago. What it is at the moment, I'm not too sure, but I can't think it's too much different. But what about the substitution of gold for cryptos? Do you see the crypto market ultimately taking over from gold?
Well, it was actually very interesting to me to hear a press release or an interview by Jamie Dimon, the CEO of JP Morgan, who said specifically that he believed that crypto was valueless. He mentioned Bitcoin in particular as being worthless, but he also believed that the general crypto sort of universe is valueless. And this has always been my belief, as you know, because there is no intrinsic value in those mediums of exchange, if you like. And more importantly, there is no regulation and there is absolutely no understanding by the participants as to why they invest capital or they buy any form of crypto token or currency, because they are not currencies. Any major bank does not accept cryptos as a deposit. If you try to sell your crypto and retrieve hard dollars or hard currency, you would not be able to do it through a normal banking source. Now, there are all these sort of side exchanges being developed and lots of unregulated schemes that offer some kind of liquidity to investors. But the reality is that this is a massive, a gigantic bubble waiting to burst. And when it bursts, there will be billions of dollars lost of investors' money. And I just hope that these investors have written it off. It is money that they can afford to lose, because they could potentially lose absolutely everything. And for me, the main danger for cryptocurrencies at the moment is regulation. When governments and regulatory authorities such as the SEC, the FCA, etc., fully focus on the fact that people trade cryptocurrencies without disclosing it on their tax returns, they will want to have a clear ownership, accountability. Every exchange and every sort of platform that offers cryptocurrency service to investors will want to know who is the ultimate owner. The know your client rule that we have been using for many decades in the fund management industry will also apply to cryptocurrencies. And that will effectively eliminate the crypto from the word, which, it's a Greek word and it means hidden. It means, secret. So all these characters and organizations who currently use cryptocurrencies for illegal activities because they don't want to show their identity will be taken out of the market. And when they have to get out of the market, a lot of these cryptocurrencies will simply collapse.
Okay, let's move on and ask the same question about gold as cryptos you're putting there. You say cryptos have no value, but gold, likewise, in its very basic form, has very little value. It's valued as intrinsic value and has a recognized market value, but at the same time, gold doesn't have a return, doesn't pay dividends. It doesn't give anybody any benefit of owning it, other than the fact it looks nice in terms of jewelry. It does have a very small industrial use, but very, very small. Why does gold remain such a sought-after area of the market in what is a very developed world?
That's a very fair comment, and it is very important to highlight that there is also a perception of value in gold, such as it is in cryptocurrencies, i.e., the supply and demand dynamics drive the price of gold bullion, and people are willing to pay the current prices because they believe it offers them a safe haven and a store of value in the light of the current monetary world. And also, it's important to point out that gold does not pay any dividends, does not pay any interest, and it actually costs some money to store it in a safe deposit somewhere. Now, the important difference, as far as I'm concerned, between gold and cryptocurrencies is the ownership structure. That gold is a real asset that is held in deposit with a designated account, with a designated owner, or it is held as a bar in a safe deposit box that you can retrieve physically and go to a bullion dealer and sell it and get hard dollars or hard pounds for it. Whereas with cryptocurrencies, everything is in the blockchain, everything is in the cyberspace. There is no specific identification other than the keys that holders own and sort of transfer cryptocurrencies from one medium to another. And it is not very easy to realize the value of cryptocurrencies and get your hard dollars back. So that is the key difference that people sort of disregard and are willing to play the bandwagon of volatility in cryptos, which is massive, as we all know, in the hope that there will be winners in the so-called greater full game. Whoever gets out at the top first is the winner.
Yes, yeah. Just going back to one of the points you mentioned in the middle of the interview, as a gold investor, how do you put your money to work? I mean, there are lots of options, aren't they? Bullion, gold bars, gold coins. shares, ETFs. What is the best strategy as a gold investor?
Well, I think the best strategy is to have, again, some diversification, i.e. to have some exposure in gold bullion, which is tangible and much less volatile than shares, for example. And perhaps one can do it either by physical gold bullion, but if it's not practically possible, you can do it by an ETF. But I always suggest looking at those ETFs that back their holdings with physical bullion somewhere, stored somewhere safely, so they can redeem a sudden rise in demand for redemptions by the sale of actual bullion, because there are many paper products out there that are simply backing their obligations with other paper rather than physical bullion. And finally, I think it's important to have an exposure to the mining industry, because they benefit from the rise in prices because of the natural operational leverage to the gold price. So, a gold miner, for example, producing gold at an average all-in sustaining cost of $1,000 makes $750 today, but if the gold price rises to $2,000, the profitability rises by a good 25%, whereas the gold price has risen much less. So there is the so-called embedded operational leverage of investing in a gold mining company, but there you have to be careful to identify the corporate specific risks. I.e., is it a gold mining company that operates well, that has a good track record, has a good growth profile ahead of it, is able to manage its operating costs, is able to manage its balance sheet, is not excessively leveraged, etc., etc. So you enter into a much more esoteric and specialized form of investment that can deliver very good returns when the market is very bullish and positive towards gold, but can also be negative and have a prolonged period of lower prices when gold turns bearish.
Okay, Angelos, look, it's a fascinating subject. Thanks indeed for joining us with this quick trip around gold and the current investment strategy that you adopt. Thanks for your time. That's Angelos Damaskos. He's fund manager of the Junior Gold Fund and a specialist in precious metals. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.